Hi, welcome to our video blog. Today we're going to discuss the difference between a bank and a mortgage broker. So getting a mortgage through a bank and getting a mortgage through a mortgage broker. It's same money you're getting from both, but the difference is the guidelines. First of all, mortgage broker, they go through various correspondent lenders, and the banks, they lend their own money. So when it comes to following the guidelines, they both follow the agency guidelines. So the two main agencies, government agencies, Fannie Mae and Freddie Mac. So they laid down the list of rules which every lender needs to follow. So when it comes to bank, inside of the bank, they have a separate mortgage company. So when you're dealing with the bank under that flag, they are running a separate mortgage company under the same flag. They also work similar way like the other lenders work. When it comes to banks, on top of the list of rules given to them by Fannie Mae or Freddie Mac, they impose their own rules, which they call overlays. For instance, Fannie Mae and Freddie Mac, they're okay to go up to 50% DTI, debt to income ratio, whereas the banks are still, their cutoff point is 43, which means a lot of people will not gonna qualify. So they have the lower DTI limit, which means if you are going to get an approval from them, instead of getting qualified for 400,000 mortgage, they might qualify you for 320 or 330. Whereas as compared to brokers, whatever the guidelines Fannie Mae or Freddie Mac have, that's what they take. They just run the DU, and if it says approved, the lender's gonna take it. That's very main point. Banks, since they are running their own, they're lending their own money, so they have their own rules. As compared to the brokers, those rules are a little lenient. Second big difference is the processing of the loan. So once you start the mortgage with the bank, so bank have a separate processing department and underwriting department. Any other lender have the same way, but not the processing. So when it comes to dealing with the brokers are the one who process the loan. They make sure everything is okay, all the documents are complete, and then they directly submit the file to the underwriting. And underwriting is the one who approves it. So what's the difference here? The difference is saving a lot of time. So when a mortgage banker in their bank branches, they take your application, they cannot submit the loan direct to the underwriting. So they have to submit that file to their processing department. So in the processing department, they go through all the file and they make sure all the documents are there. They take like 3 to 4 days, which you can save right there if you're doing a loan through the mortgage broker. So the bank's processor, they take that time, and if there's any document which is not there, they will NOI the file, notice of incompleteness. And by doing that, they buy 15 days of time. So they give 10 days notice to the customer to send this document back, and then they have 15 days to hold that file. So if you are in that category and you're in limbo, your file is not moving anywhere. And guess what? If you have a 30 days closing on some of the purchase you're doing, and you have one document short, and once your file is on the side, they'll take another file and go with it. It's not that they'll take all 15 days, even if you give the document to them, but they can easily eat 6, 7 days. That's not with a mortgage broker. So if a good mortgage broker, if they know how to, submit the loan, which most of the brokers they do all that paperwork and submit the file directly to the underwriting, which take 2 days to approve. So as compared to 15 plus the underwriting days, your file is getting approved in 2 days. We don't promise the sooner closing, but a lot of the cases we have closed the loan successfully between 15 days. It's from application to funding. It's how fast the client give the documentation to us and how fast they are acknowledging the lender's email when it comes to us to acknowledging the LE or the CD, which is loan estimate in the beginning and closing disclosures in the end. And so, the difference. Main difference is their overlays, which kills the loan process. So many things agencies are saying that they can easily do it, banks are not. Thank you very much for listening.